Hello friends and everyone. If you receive the age pension, a part pension, or you're holding a Commonwealth Seniors Health Card, I need 5 minutes of your full attention because something has quietly shifted in the way Services Australia looks at your bank account, and most pensioners have no idea it's happening until a letter turns up in their MyGov inbox. Here's the short version. Centrelink isn't just glancing at what you tell them anymore. Their data matching systems now compare what you declared against what your bank, your super fund, and the tax office are actually reporting. And they're doing it faster and more often than at any point in the program's history. If there's a gap between the two, even a small one, even an honest one, it gets flagged. And once it's flagged, some pensioners are seeing their payment paused before anyone has explained why. That's not a scare campaign, that's simply where the system is at in 2026. And the pensioners who understand how it works, who know what triggers a review and what doesn't, are the ones who sail through without a hiccup. The ones who don't know, they're the ones opening their banking app on payment day and finding nothing there. So today I'm going to walk you through exactly what's changed, who it actually affects, the real thresholds and numbers for 2026, the everyday mistakes that catch honest pensioners out, and, just as importantly, the entitlements a lot of you are still missing that have nothing to do with any of this scrutiny. Stick around, because the second half of this video could genuinely put money back in your pocket. Before we get into it, if you haven't subscribed to this channel yet, now's the time. The rules around the age pension, deeming rates and asset thresholds move twice a year, every March and September, and Services Australia does not ring you up to explain what changed. They update the policy and leave it to you to keep up. That's the entire point of this channel. I read the updates so you don't have to chase them down after the fact, after a payment's already been reduced. Hit subscribe, turn the bell on, and let's get into what's actually going on. What's actually changed? For a long time, Centrelink's compliance checks worked in batches. Someone's file would come up for review every year or two, a caseworker would request some paperwork, and life would go on. That system still exists, but sitting alongside it now is something far more continuous, an automated data matching pipeline that pulls information from financial institutions, the ATO, and super funds on an ongoing basis, rather than waiting for a scheduled review. In practice, that means the gap between something changing in your finances and Centrelink noticing has shrunk dramatically. A term deposit that matures and gets rolled into a new account, a joint account you share with an adult child, an inheritance that lands 3 weeks before your 6-monthly review is due. All of these used to sit quietly until someone looked. Now, in a growing number of cases, the system flags the mismatch on its own, sometimes within days. And here's the part that catches people off guard. A flag doesn't always come with a phone call first. For some recipients, the payment is automatically paused while Centrelink waits for you to confirm what's going on. You get a message in your MyGov inbox, and if you don't see it, don't check it, or aren't confident navigating it, that pause can drag on far longer than it needs to. None of this means you're being personally targeted, and it doesn't mean you've done anything wrong. What it means is that the margin for "I'll update that later" has essentially disappeared. In 2026, later is often too late. The innocent mistakes that trigger a review. Here's what I want every one of you to sit with for a second. The overwhelming majority of pensioners flagged by these systems haven't done anything dishonest. They've simply lived a normal life without realizing which parts of it needed to be reported. Selling the caravan or the second car, helping a grandchild with school fees from a joint account, consolidating 3 small savings accounts into one at a different bank because the interest rate was better, receiving a modest inheritance and parking it just for now while you decide what to do with it. None of these are wrongdoing. All of them are the kind of ordinary financial housekeeping that happens in any given year, but every single one of them changes a number that Centrelink is now watching in something close to real time. The frustrating part is that the system doesn't know your intentions, it only knows the numbers. It can't tell the difference between someone quietly building wealth they haven't declared and a 74-year-old widow who moved her savings to get a better term deposit rate. Both look identical on paper. That's exactly why staying ahead of it matters more than it used to. What to actually do about it? So what does staying ahead of it look like in practice? It's genuinely not complicated, but it does require a bit more attentiveness than it used to. First, get into the habit of checking your MyGov inbox at least once a week, not once a month. Notices about required updates typically come with a response window, and missing that window is what turns a routine check into a payment suspension. Second, if your financial circumstances change in any meaningful way, a lump sum arrives, an account closes, you sell an asset, someone moves in or out of the house, report it through your Centrelink online account as soon as you reasonably can, rather than waiting for your next scheduled review. Reporting proactively is treated very differently to being caught out after the fact. Third, if you share a bank account with a family member and the money genuinely isn't yours, don't assume Centrelink already understands that. Get it documented. A simple statement outlining the ownership split, backed by evidence of who actually contributes and withdraws, can be the difference between that balance being excluded or counted in full against you. Fourth, keep your contact details current. Email, mobile number, postal address, all of it. It sounds almost too simple to mention, but outdated contact information is one of the single biggest reasons pensioners miss a verification request and end up with a paused payment through no fault of their own. And fifth, if a payment does get suspended and you believe it's a mistake, don't sit on it. You have the right to request a formal review, and if you can show that you remained eligible the whole time, Centrelink can back pay you for the period you missed. The key is acting quickly. The longer a suspension sits unresolved, the harder the paperwork trail becomes to reconstruct. The flip side, what you might be missing. Now, here's where I want to shift the mood a little, because this video isn't only about what Centrelink is watching, it's also worth asking what they're not automatically giving you. Because in Australia, entitlements almost never arrive without you asking for them first. If your income sits above the pension cutoff, but you're still on a reasonably modest budget, check whether you qualify for the Commonwealth Seniors Health Card. It doesn't pay you a cent directly, but it can meaningfully cut the cost of prescriptions and, depending on your state, energy bills and council rates too. And a surprising number of retirees who miss out on the pension never realise the health card is a completely separate door with its own much higher income limit. If you're working part-time while receiving the pension, make sure you understand the work bonus. The first few $100s you earn each fortnight through work isn't counted against your income test at all, and any unused portion banks up over time, giving you a buffer for future work. A lot of pensioners quietly stop taking on shifts because they assume every dollar earned costs them $1 of pension. For most people, that's simply not true. And if you're a homeowner who hasn't looked into state-based pensioner concessions on council rates, water bills, or car registration in the last couple of years, it's worth a phone call. These programs vary by state, they're rarely advertised well, and the eligibility can shift when the pension rates are indexed in March and September, meaning some retirees who missed out last year might now qualify without having done a single thing differently. Bringing it all together. So here's where that leaves us. Centrelink's ability to see into your financial life has genuinely expanded in 2026, and pretending otherwise won't help anyone. But that expanded visibility isn't a reason to panic, it's a reason to be a little more organized than you might have been in previous years. Keep your contact details current, report changes as they happen rather than waiting for the next review. Understand your joint accounts and document them properly if the money isn't fully yours. And know your numbers, the asset thresholds, the deeming rates, the gifting limits, well enough that nothing catches you by surprise.
At the same time, don't let the fear of scrutiny stop you from claiming what you're actually entitled to. The work bonus, the Commonwealth Seniors Health Card, state concessions, these exist whether Centrelink is watching your account closely or not, and none of them get handed to you automatically. If this video cleared something up for you, do me a favor and subscribe, because these thresholds move again in September, and I'll be breaking down exactly what changes the moment it's confirmed. And if you know someone, a parent, a neighbour, a friend down the street, who's on the pension and hasn't checked their MyGov account in a while, send this their way. It might be the nudge that saves them a very stressful phone call down the track. I'll see you in the next one.